just a bit about my background. So I'm a restructuring partner at PwC. I was involved with the Treasury in setting up, or worked for the Treasury in setting up the Asset Protection Scheme and the Asset Protection Agency for RBS, and also I advised the Irish government in relation to setting up of NAMA. And I've been involved in preparing restructuring plans for various of the banks across Europe, which have been in receipt of state aid, which have to provide a restructuring plan as part of that. And we'll come back to some of the sort of nuances of that. Also currently providing advice in relation to the study that's going on as to whether or not there should be a good and bad bank split for RBS, which is a bit of a political hot potato. And I'm just in the course of doing the valuation of the UK assets of IBRC, which again I'll come back to, which is quite a sort of topical aspect, and I think it's certainly very relevant to the conversations that we might have in a moment or two. And I've also done a lot of real estate workouts for large banks, Lloyds and RBS in particular, HSBC, a number of the other banks. I mean, you can probably judge by my age, this is my third recession. So I'm going to make a few comparisons particularly between the 90s recession and the recession now that we're in at the moment, because they are very different, I think. If you go back to the 90s, we had broadly well-capitalised banks. Obviously, the scale of the problems were much smaller than they are now. Workouts tend to happen quickly. I mean, it was mostly about enforce on collateral, sell collateral, move on. The banks were able to sustain the losses by and large. There's plenty of acquisition finance out there from the banks to fund traditional acquirers, if I could put it that way, in that recession. And so a floor price, which I think is a key point here, and a floor price was established reasonably quickly, and we moved on. And although it's painful at the time, I mean, probably if you said the recession started in 1990, it was by and large, it was sort of, and the end of it was sort of 95, 96, and we'd moved on. Roll on to 2007 and where we are now, I mean, obviously on a much larger scale than all of that. And also, I mean, one of the key differences here is that this isn't just a recession, it's a recession with a banking crisis as well. The IMF did an interesting study about what the length of recessions are where they're linked to a banking crisis, and by the general evidence seemed to be that they lasted at least 50% longer. Now, you can see if you look at the sort of, if we project 10 years ahead from, say, we said 6 years plus 50%, you could be looking at sort of 10 years here from 2007. So, I mean, we're in the middle or in the back end of this, but it doesn't feel to me like we're anywhere out of the woods at the moment. So that sort of timescale feels as sort of what we're working to. And again, that's probably quite an interesting reference point in terms of your own planning and your investment time horizons. I think the other thing that we've seen is that the scale of the problems have been so large that they've been, in some cases, they've been inextricably linked with the viability of the state. So if you look at Ireland, Spain, Belgium, Greece, Cyprus, the scale of the problem for the banks has in effect almost undermined the issues for the state as well. And whereas, say, in the UK, we were able to put, as part of the salvaging RBS, we were able to put a state guarantee, a state wrap around that, which was a AAA rated, it was at the time, AAA rated wrap around that. You just couldn't do that in places like Ireland, because actually the credit rating of Ireland itself had got so low that it was sort of, it was indistinguishable from the bank. So there were a limited number of options in terms of what the state could do in those circumstances. I've spent quite a lot of time in Ireland, a bit in Spain as well. I mean, Ireland is an interesting case and is often used as a sort of a model. Sometimes people don't like to say that it is, the model that they should look to. But there are a lot of things that people look to Ireland in terms of what they did. They were reasonably quick out of the traps in terms of what they sought to do with NAMA. Some of the corrective actions that they took in relation to the economy and so forth. They're by no means out of the woods. I think that Ireland is a more interesting case because it has a thriving export economy. So the domestic economy may be pretty parlous, but it does have a strong export economy, which is keeping quite a bit of it going. And if you look at, say, places like Dublin, actually the market there, from a real estate point of view, is reasonably vibrant. obviously go out into some of the regional parts of Ireland, and it gets rather different. I mean, and comparing Ireland and Spain, I mean, those were both, fueled by bank lending into property and construction. So I mean, there's quite a lot of similarities. And if you look at the solutions in Spain and Ireland are not dissimilar. They've both set up a bad bank. They've tipped in large amounts of assets with a view to working them out over a longer time period. Spain is sort of trying to go with a shorter time frame. NAMA was set up with originally envisaged with a sort of 7 to 10 year time frame, and so they're sort of slowly working their way through those problems. But I mean, they're still, there are, it's moving, but it's moving slowly. I think when, for instance, NAMA has focused on selling off its non-Irish assets. So I mean, it sort of looks better at the moment because it's actually managed to dispose of, and is disposing of, particularly of its UK assets. I mean, roughly, I think 25% of the book was UK anyway, that they took over from the participating institutions. So they've been moving on that reasonably well, but they've got a rump which is going to prove quite hard to sell, I think, and to move on in Ireland. I mean, there have been some portfolio sales, but at heavily discounted prices as well. I mean, I mentioned IBRC, which I think is quite an interesting case at the moment. It's quite topical. So you'll have seen in the press that there's having gone into special liquidation, the intention is that the book will be sold, and ideally it would be sold to the market. Well, it'd either be the borrowers will be offered the prospect of refinancing, or it'll be sold to the market, or it'll go to NAMA. And part of our exercise is establishing the floor price for what would go into NAMA. But it's one of the things that the Irish state has said, and you see it elsewhere, is they don't want these things to be sold off at absolutely rock bottom prices. It's really just exporting capital out of the country. So the price that it's being set at is basically looking at the cash flows and discounting them at NAMA's borrowing rate. So it's quite hard for third parties to come in and match that sort of pricing. But it's because they don't want to see these things sold off at what you arguably might be the right price, but it might be too low. But they're not prepared to see that, and I think you'll see that in other countries in terms of how they actually go about disposing of these things. There's still quite a there's a tension at the moment because a lot of the banks that received state aid in particular, there's about 50 banks across Europe received state aid. I mean, as part of the receiving state aid, they had to agree to a restructuring plan, which includes what's called burden sharing and involves largely disposing of non-core assets. In Ireland, I mean, they had a fairly blunt tool, which is that the loan-to-deposit ratio had to come down below 120%. So it's forced the bank. So you've got the tension of the bank, of the troika, and sort of international authorities wanting, the banks to de-gear, but at the same time, the state's not wanting to de-gear too fast, because if they do that, as I say, they export capital. And in fact, actually, if you sell these things out too quickly and at too low a price, you then end up probably with a recapitalisation. I mean, when we see quite a few of the banks, they hadn't marked, and they probably still haven't marked their books necessarily to the real value at which some of these things can be sold. That's Ireland and Spain. UK and Germany, I think, sort of are two different ones. I mean, I think the UK, it's going through. At least there's liquidity in the market in the way that I don't think you see so much in Spain and Ireland. And there has actually been a fair amount of de-gearing. If you look to the amount by which, for instance, RBS's balance sheet has come down, I mean, it's 2.3 trillion is the overall size of the balance sheet in 2007, where it's now below 1 trillion. And if you look to the sort of non-core assets, they're way down on what they were to begin with. The real estate assets way down on what they were. So I mean, they've been gradually moving things out. They're not necessarily been done by large portfolio sales, but they've worked through these things. They've either been refinanced, they've sold the underlying collateral. Lloyd's has also been pretty active in moving on its problem loans. So it's happening in the UK. That doesn't mean to say that we've sorted out all of the problems, and there's still a lack, as you know, of debt finance to necessarily acquire all of these things. I mean, Germany is an interesting example. I mean, Germany, I mean, of the 50 banks across Europe that receive state aid, 15 of those were in Spain, roughly. 10 were in Germany. So we think Germany didn't have a problem in some ways, but it did. I mean, so there's 10 received state aid. But they've gone about, you know, if you look at the two state banks there that have been, state runoff banks that have been set up for West LB and for Hypo, they've gone about it in a totally different way. And basically they've transferred assets in at carrying value, funded by external debt guaranteed by the state. So it's got very low funding rates. And so what do you see? You see a very long workout time horizon for those sort of assets in Germany. You know, questionable whether that's the right answer. You know, it still leaves you with questions about have these things really got to being marked down at the right floor price. And I've mentioned, I've mentioned the UK. I think, you know, we still haven't necessarily got to the bottom of, we haven't got to floor prices necessarily. I mean, I do think, you know, the accounting profession of which I'm one has something to answer here in terms of the way that we do impairments. And as a result, they don't actually necessarily really reflect losses because you can't anticipate losses in the future. You can only look at things that you know about at the moment. So, and that's resulted in a huge amount of gaming by the banks and not recognising losses in the balance sheet at this time. But, you know, so there's quite a mismatch between the balance sheet and, you know, some of the exercises that have been done by the likes of BlackRock, where they've actually looked at the estimated lifetime losses on these loans. So there's still that sort of disparity at the moment, which again is causing sort of, you know, this tension about not being able to necessarily divest as fast as they might want to. I might mention also just Greece, because I was there last week in Athens where we saw the central bank and the stability fund. I mean, Greece has really got into, you know, although the mood is improving, I think that's just because everybody's got fed up with being depressed, but there's not necessarily reasons to be cheerful. I mean, it's completely gummed up at the moment, and it's an extreme example of what I've just been talking about, in the sense that the banks have not recognised, they're nowhere near recognising what the underlying real value of the assets are that they've got. BlackRock are in there doing another exercise. They did one about 2 years ago. I mean, the view is that they well undershot what the likely losses are in those banks. There's very little room to manoeuvre in terms of potential recapitalisation. So there's just nothing happening in the market because nobody really knows what the underlying floor value really is. And there's a lot of structural reforms that still need to take place, particularly around workout and restructuring, in order to be able to actually ungum the works. So we were talking about some measures that they might do to actually ungum the works in Greece. So that's just a few thoughts in terms of some of the countries. You know, one of the points that sort of was raised, what do the past cycles tell us about the future for now, and where's that going? What are the investment opportunities? I mean, I just think this recession is very different from previous ones, and therefore the past isn't necessarily a reliable guide. As I say, I think establishing the floor is absolutely key, and, you know, the sooner we see that, you know, that we have really reached a floor, confidence comes back. People can make proper investment decisions because they know where these assets potentially sit. I still think, you know, there's going to be a sea change in the way property is funded in the future. I mean, I do think I could see the banks. The obvious role for the banks is much more the originator and distributor, even though, you know, ironically, which is sort of what Northern Rock was doing. But in a way, I still think that's actually a good model as long as you avoid the moral hazard associated with that. And I think, you know, if we see new forms of funding coming in, and we'll probably talk about that in some of the things that we're talking about now, that all helps to ungum the works and to get back to where we want to be. So anyway, that's just a few opening remarks. Hopefully that's helpful.
Great. Thank you.